Good afternoon, everybody. I'd like to welcome everybody to the special called meeting of the County Employee Retirement System Investment Committee. This is a special called meeting. Eric, could you read the opening statement, sir?
Of course, this is a special meeting of the County Employees Retirement System Board of Trustees Investment Committee. The meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Okay. Thank you, Sherry. Could you take the roll, please?
Yes, sir. Dr. Hackbart, Mr. Cheatham,
Here.
Mr. Fulkerson,
Here.
Mr. O'Meara, and Mr. McGraw.
Here.
Thank you.
Okay. There being a quorum present, we'll go ahead and pursue. I understand there were no public comments for this meeting.
That is correct.
We're going to discuss two private equity opportunities that have been presented. One is the Valor Equity Partners Fund 7. The other is Arctos Keystone Partners Fund 1. I'll turn this over to John. Are you handling the presentation, or David for Valor?
Yeah, John's going to take the presentation of Valor, but this is another private equity investment in line with the pacing that we approved earlier this year. And with that, I will turn it over to John to talk about the investment, where it fits into that pacing.
Thank you, Chris. I apologize. I didn't see you down there on my screen.
No worries. I'm hard to find sometimes.
And I apologize, Lyle. My technology was struggling to come live.
It's Monday. That happens.
Sure, I'll jump right in. I think that we have a handful of slides in here that really kind of just refresh on, the roadmap that we built with you all and covered in February. That really is kind of your private equity pacing and how to get closer towards your private equity targets. But I think for today's purposes, we can just jump right into the discussion on Valor. And I'm not sure if our one-page summary is in this version of the materials.
I believe not in this version, John.
Okay, got it. Well, I'll just cover Valor as a strategy, and happy to take questions as they come up. But so Valor Equity Partners is a private equity firm focused on making minority growth equity investments in high growth companies that exhibit what they call pro-entropic features. All that really means is these are businesses that benefit from technological or secular tailwinds, and they believe that these businesses can really perform and expand and scale across economic cycles, across uncertainty that we're seeing right now, geopolitically or elsewhere, and across market disruptions. The firm was founded in 2001 by Chief Investment Officer Antonio Gracias, along with Jonathan Shulkin and Timothy Watkins. The firm has successfully raised 6 flagship investment vehicles, with Fund 7 being its 7th iteration of the flagship investment strategy. It's also raised 2 opportunity funds, 2 venture capital funds, and 2 recent joint ventures. And has assets under management of a little over $30 billion as of the end of last year. While we note that typically when we see strategy proliferation, which just means a firm adding new strategies, that can oftentimes be a little concerning. But in this case, each of the strategies that Valor has raised around their flagship fund really supports the firm's overall ability to invest across the life cycle of the businesses that they target, and so is really not a concern to us. Fund 7 specifically will continue the firm's flagship strategy of investing in companies that are benefiting from a shift in the economy towards a technology-enabled economy. And they'll focus on businesses that are at an inflection point of their life cycle. These businesses are typically going to be, they're going to have product market fit already. They'll typically have significant revenue, and oftentimes will have profitability at the entry point for Valor. Valor will take a generalist approach across the broad sectors of AI, consumer, services, and engineered products. But our expectation is that, Valor really takes a targeted approach to the themes that they build. And for Fund 7, we're expecting to focus on advanced engineering, artificial intelligence, molecular engineering, and then computing and hardware. I think one of the most significant things to note here is Valor really differentiates itself through its hands-on approach. Most times in the growth equity market, these firms are minority investors, and so they don't have a position of significant influence. But with Valor, they have a 35-person operations team. They call it their scale group. And at any given time, this scale group is running hundreds of different projects at portfolio companies across Lean and Six Sigma, across revenue generation, and just many different types of value-creating projects at the portfolio companies. We view this as extremely differentiating within the growth equity market and has really ultimately led to significant success. So if you look back at Valor's unrealized track record, top quartile performance on a net ROI basis for every single one of their 6 predecessor funds, and top decile performance versus peers on a net ROI basis for Fund 4 and Fund 5. So a group that has experienced significant success. We note that performance outside of Fund 1, Fund 2, and Fund 3 has all experienced strong realized performance as well. But Fund 4, Fund 5, and Fund 6 are still maturing. And Valor has learned some lessons over its lifetime. One of those being that sometimes it does not pay to get off the bus too soon, and they've built up some scar tissue, and so they've held on to some of their more recent investments a little bit longer, and so DPI or realized investments has suffered as a result. But with the notable SpaceX news, we expect that DPI to come up in those more recent funds soon.
John, I'm going to jump in for 1 second. Sherry,
Yep.
I think we want to be back just for a few minutes in pages like 2 through, for John, where you outlined the pacing, et cetera. This is, I guess, start on page 2 and then move, if you wouldn't mind, please, through there quickly.
Sure.
You kind of covered that page, John, but then the pacing.
Yeah, jumping back out of the Valor, just jumping in. Okay. So yeah, we're recommending a $40 million commitment to Valor. We believe that this is a good slot for your growth equity portion of your portfolio. If you remember, we broke your portfolio down into buyout, growth equity / venture, and we believe that Valor, a $40 million commitment to Valor, would be an appropriate commitment for the venture growth portfolio. I was going to touch on it, just a few other elements of our diligence, and maybe just jumping back in if that's all right. Some of the things that I mentioned a lot of the highlights, but some of the things we really had to get comfort around for this investment strategy is, first, the firm has a great network, which is key to the success of a growth equity portfolio. But a significant portion of that network, or at least a very core piece of that network, is to Elon Musk-backed companies. And so, they were early investors in Tesla, in the Boring Company, in XAI, in SpaceX, more recently in Neuralink. We needed to get comfort around the fact that not only could they continue to generate deal flow from that network, but that they were also getting deal flow from other networks as well. And they have had great experiences with other non-Elon Musk backed companies, specifically companies like Anduril, which some of you may know. It's an American military technology company specialized in advanced autonomous systems. Also Crusoe, which does data center build outs, GoPuff, Nirvana, Harmony, Adipar, a financial services business. So they've had strong investment performance across other non-Elon Musk backed companies, and that's something we had to get comfort with. Another element of the strategy that we needed to get comfort with and did a significant amount of diligence around was the key person risk surrounding Antonio Gracias. He's been key to deal sourcing and has been a significant part of the firm's success. As we really dug into this strategy, other partners like Jonathan Shulkin, like Juan Sabater, Brad Scheftel, Vivek Padi, these are all very strong investors and are highly aligned with the firm. And we believe that they're significant pieces of the team as this team moves forward and really help to mitigate the key person risk associated with Mr. Gracias. And so we were able to get comfort there. And then finally, I think the last thing we identified more in previous underwritings and less so in this one, but the firm did experience a significant amount of turnover between 2020 and 2022. A lot of that, some of it had to do with COVID and some of the remote work situations. A little bit of it had to do also with the fact that given the firm's large operating team, a lot of those operating individuals are very entrepreneurial minded. And so oftentimes we'll see that team can have turnover when individuals who are used to operating or being entrepreneurs go back into an entrepreneurial role or decide to start a company. And so we did see that turnover between 2020 and 2022. It has subsided significantly over the last 4 years. And I think importantly, we've been able to talk to a lot of the departed employees. We've conducted exit interviews and past underwritings and feel comfortable that there's no major cultural issues or nothing really specific that led to that turnover in 2020 to 2022 timeframe. So again, just something we've identified in past underwrites, but wanted to identify and outline how we got comfort with some of the concerns for the strategy. But again, high quality group. We're excited about this group. We've had a significant amount of interest from our other institutional investor clients, and we expect this strategy to get raised to the hard cap and likely to be oversubscribed as well. So that was super long-winded. With that, I will open it up to questions.
John, I've just got a couple. If you could touch on what Valor's past history and what their expected net return on investment is expected to be, and then the net internal rate of return.
Sure. Yeah, so they target typically in the neighborhood of kind of 3x, 30% is what they're looking for at the deal level. We would expect their fund level returns to be in that range as well. They've really done a great job of mitigating their loss ratio in recent vintages, and so that's kind of their target as far as return goes. It's a higher return target than what we're seeing in a buyout space, just given that minority investment is typically a higher risk profile investment than a majority buyout like we saw with Capital Meridian. So targeting a higher return for a what I would call an equally slightly higher risk profile as well.
Okay. And then if you'll touch on exit strategy here, that's something that we we're trying to focus on a lot going forward.
Yep. Yeah, exit strategy is important, specifically within venture capital and growth equity, given that the IPO markets have been relatively muted in recent years. We've noticed that there has been a bit of an uptick in IPO activity, obviously with SpaceX, but we expect typically that the Valor investments are going to have a number of different exit routes, but IPO, trade sale, sponsor transaction is going to be the typical exit routes that they're going to take. And we've seen with the IPO markets opening up a little bit, SpaceX being the most recent, talk about OpenAI and others potentially IPOing here soon. There could be potentially a little bit more of an exit opportunity through the public markets.
So timeline I see on here is 6 years, 10 years on the investment. So you don't anticipate we're going to be married to this thing for the next 20 years or something, right?
That's right. And first, I would say, don't think of this as kind of a early stage venture strategy in which, you're thinking about 13 to 14-year-old fund terms. Think of this as more later stage growth equity type strategy. So yes, I totally agree with that assessment. The other thing that I would mention is, we continue to see the continuation vehicle market as a potential avenue for exit. Valor has actually recently looked at this market for exits in a couple of their Fund 3 and Fund 4 businesses as well. And so we view that as another solid exit market as well.
Okay. JT, Tommy, either of y'all have any questions? Ed, you got any? I know you've sat in on some of these meetings. You got anything you want to add?
Thank you, Mr. Chair. No.
You asked my question about the exit strategy.
I think we're focused on that one pretty good, Tommy.
Yeah. Yes, sir.
Okay.
But I'm a Elon Musk fan. And anything that's going to be kind of tied to him is historically done well. So, kind of excited about this.
Yeah. Okay.
Tommy, and if you wouldn't mind, if I could make one note, Tommy, you bring up a good point. So Fund 7, I forgot to mention this, they've seeded the portfolio with 7 assets. One of those assets is actually SpaceX. And, you'll be actually getting into SpaceX at what we expect to be a discount to the publicly traded stock price. So an interesting way to place SpaceX without having to buy in at kind of current marks.
Well, I guess I do have a question now that I've thought about it a second. So I know that they're supposed to put some warrants or something out, SpaceX is. I just wonder if that's something that's kind of going to be bridged into this.
I'm sorry, can you repeat that, Tommy?
SpaceX is supposedly going to put some warrants out or something here in the next 90 days. I figured this fund would kind of bridge into that a little bit. I didn't know.
All of the exposure that you would have access to is existing equity that Valor already owns. So they will not be buying future shares of publicly traded SpaceX stock.
Got you. Okay, no.
Yep.
All right. And your recommendation, you said was 40 million, correct?
That's correct.
Okay. Well, I tend to agree with Tommy. I kind of like the looks of this. I like the history behind Valor. So I'll entertain a motion to accept the recommendation of investing 40 million in the Valor Capital Fund or Equity Partners Fund 7.
Motion made.
Got a motion
Second.
And a second. Any discussion? All in favor signify by saying aye.
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 Aye. All opposed? Nobody left, so motion passes. The next item on the agenda is Arctos Keystone Partners Fund 1. Anthony, is this yours?
Yes, thank you. We could go to page 15, please. Okay. Yeah, Arctos Keystone. This is another strategy from Arctos Partners. We have CRS already has an investment with Arctos, both in Arctos Sports 2 and the Arctos American Football Fund, which is focused on NFL exposure primarily. Another business that they have is called Keystone, and that is just like solving problems for sports team owners. This helps GPs, other private markets firms, solve problems. So whether they're trying to grow into different areas, solve succession issues, fund commitments for GP commitments for new funds. There's a variety of things that they are able to do, and that fits with their background of being secondaries people previously. They kind of got the band back together. Ian Charles did with some folks that he worked with at Landmark, which is a secondaries firm that they worked at prior to it becoming acquired by CERS. And so they launched a strategy about almost 3 years ago. And so we've been following it since then, and is closing basically now. So there is a lot of visibility in the portfolio, and so that we've been able to watch the strategy and see if it could grow, get their team back, get some deals in the portfolio, and it has been doing it as I said it would. So if we can go to the next page, please. This is on here, but you guys have seen it on your books. They have 10 deals now. 11 deals have closed so far. And the way what the investments are typically structured, kind of like preferred equity, basically, into these different GPs. And then what they will do is contribute pieces of some different cash flow streams into an SPV. And then the Arctos will have first claim on that. So that will be like management fees of current funds, carry, GP commitments. So those are pledged by the managers, and then there's the investment can be self-liquidating in a way in that after the thresholds that are agreed are reached, then Arctus's investment goes away. So, like for example, it might be like 1.5 and 15%, 1.5 multiple and 15% IRR. So once it meets that, then Arctus's investment could go away, or it might sometimes just step to a different point. Like instead of 100% to Arctus up until that point, then the next part might be like 50-50 or 80-20 till it reaches the next threshold, which might be 2x or something like that. Every deal is bespoke, so they're doing it to help solve the problems of these different GPs. And it's a more interesting solution. It's a more applicable solution than just kind of the other alternatives that are out there. The other ones you see are usually secondary. People have to sell minority stakes in their firms, and there's a lot of folks who don't want to do that necessarily. They might take NAV loans against the existing assets, so those are kind of some of the things that compete against us. But this is an interesting investment. It's relatively expensive capital for the GPs, but it means that they don't have to sell a stake in their firm permanently, and the investment will go away, assuming that the firm grows like the GPs usually think they will. So that's kind of how it works. That they end up being in some has to work together. Obviously, Arctos has a lot of experience working with GPs from the past few years here at Arctos and also at Landmark. So that's kind of a lot of the sourcing and the relationships and their ability to help GPs, right? Like usually it's not like GPs can, not like sports owners where they get together and you talk and you can figure out best practices. Usually GPs are competing against each other. So, the head of one firm isn't going to talk to the other one about problems they're having or things they're trying to figure out, but Arctos as a neutral party can help them and has. And so that's another thing that helps make the investment interesting, aligned, and usually, it's not accessible easily anywhere else. This is something that they're figuring out with these partners, and they've obviously gone to them because it's not like something they went out to the broad market to figure out. So we think it's kind of a unique way of accessing private markets. Returns are still pretty good because that's the thresholds that they have for their capital. So but it also gets us out. There's a way to be out, unlike regular PE funds. Like I think you asked earlier about Valor. There's no assurance that it won't be 20 years. We do have a venture fund that is from 2000. That's our oldest fund in the book. Right? So, and I think the second oldest is maybe from 2005. That's a buyout fund with one asset left. So there's nothing in the docs that forces them to be done. But here in these documents, like the sports fund, there are liquidity opportunities at year 10, 14, 18, and every 4 years after. So those are structured in the documents. So, and happy to take any other questions.
Couple of questions, Anthony.
Sure.
You indicated they've already closed. Would you say 7 or 12? I can't remember.
11.
11.
11.
what's their average timeline as far as, looking at a deal and getting it closed? Is that, short?
It's a long cycle. It's a long cycle, right? I mean, these are relationships, and these are things that, if you're running a $20 billion asset manager, you're not, taking it lightly. You're thinking through what you're trying to solve. And, so these are relationships and take a long time. But, a lot of times they've known each other and perhaps done stuff with each other at Landmark. So, and, it's a trusted thing. And then there's obviously structuring that has to be done and worked out. So it can take a while, but some can be really fast. There's one that's very large, actually, that they're talking about closing the next 3 to 4 weeks. That just, I mean, it came, just within the past few weeks since we, before just in June, and it might close in the next few weeks. So sometimes it can be really fast, and obviously they are able to move quickly because they have a large database and relationships. We could talk about their Arctos Insights, which they utilize in terms of leveling all the different GPs that are out there. So they can kind of put them in the slot universe of, what life stage they're at and how many products they have and, what they fit like. And so they have a lot of that information and can move quickly. And so that's something that is good. But it really varies. I mean, some of these they've done deals with before. Some of them, I know one of them was came through and was going to be one of their first deals, died, came back. It is their second deal, but so it really varies.
Okay.
Mhm.
And based on the conversations we had earlier, and Ed, you may want to chime in on this a little bit. I took it that a lot of these deals were to finance buying out the main owners, and you all expect anyway that our original investment would get returned back to us in a pretty short order of time, where I think it was put to us, that we'd be basically operating on their money after that. What timeline are we expecting?
Oh no, I mean, it's not that quickly. It's I think that our Keystone generally targets getting your money back 1x DPI in about 5 years. So, which obviously, I mean, that's pretty decent compared to just regular private
I would
equity.
say in this environment, it seems like 5 is pretty quick.
That would be fast, but that's just getting your money back, and then obviously out and return on and return of capital year 9 is their goal. And I think that the GP case is usually a little bit more optimistic, right? Maybe they say about 12 to 18 months, a year to year and a half inside that. So the sponsor thinks 3 to 4 years. Arctos have 1x back, and then exit maybe 7 to 8 years, right? Ideally, but of course they are expecting their fundraisers to go well, their exits to go well and fast. So there's 2 different cases, but the Arctos case is obviously more conservative. But yeah, they're secured on the SPV. The cash flows are going to the SPV, which are management fees and carried interest and things like that. So in some ways, I mean, there's some people I think they said can view it as credit. I don't necessarily view it that way, but it does have some elements of that in terms of there's cash flow that can come back and helps de-risk and obviously gets the investment more liquidated. So
okay, so just to pin that answer down a little bit,
sure.
You're thinking more 5 to 7 years?
No, I mean, I think it's 1 year, 5 years for 1x to get your money back, and then the return and full exit year 9.
All right.
That's
I don't mind, as long as we get our money back in a reasonably short period of time. I don't mind operating off the bank's money after that for a while, but I just wanted to get a little clarification on that, on expectation.
Sure. I mean, obviously, there's a lot of incentive for the GPs to use expensive capital for them, right? So they are incentivized to extinguish this as fast as they can. But that's partially why also why Arctos puts in the minimum multiple thresholds, right? Because otherwise, let's say they have a big exit and they can just pay it down. That's great that you got 18% IRR or 30% IRR, but for a year, but not that much multiple, and then you're out. So that's why they have the and test for these is typically a multiple and an IRR.
Okay. Anybody?
Yeah.
Tommy, JT, Ed.
Mr. Chair, thank you
wants to come in
for allowing me to speak to this, because we did have an opportunity to have a call with the GP of Arctos Keystone, and I must admit that the Arctos Athletic Fund is absolutely my favorite investment that is in our portfolio. And I really like the structure of this. As Anthony just stated, the over-collateralization that Arctos Keystone requires of the GP to put into the special purpose vehicle incentivizes that GP to liquidate and extinguish that special purpose vehicle as soon as possible. But they have to meet both the multiple hurdle and the IRR hurdle in order to be able to do it. And what really put me over the top with Arctos Keystone is once that special purpose vehicle is extinguished, they view that as a distribution event. So there will be distributions that will come when those special purpose vehicles are extinguished. Really like this. And the only reason that I think the number of this should be 75 to 125 is that we're already substantially committed to this GP, and just from a standpoint of concentration, we might not want to do more than that. But this is something that I do think would benefit our portfolio substantially.
Okay. You know, I've looked at that, and you know, in keeping with our pacing schedule, I'll you know, one of the things that I always liked about that when it was presented was taking smaller bites but more of them. But I believe 75 gets us to where everybody gets their break point. So I you know, I'd feel comfortable at that level unless somebody else has a different opinion.
I agree.
Okay. Well, if nobody else has any other questions, I'll entertain a motion. Tommy, I'll take that as a motion to approve a 75 million investment in Arctos Keystone Partners Fund 1.
Yes, sir.
Second.
Second by JT. All in favor signify by saying aye. Aye.
Aye.
All opposed? Ayes have it. Motion passed at a $75 million level for investment in Arctos Keystone Partners Fund 1. There being no other items on the agenda, I will entertain a motion to adjourn. We'll see each of you guys again here in about 9 minutes, I think.
Right.
Yes, sir.
All right. Thank you very much.
Thank
Got a motion, got a second. All in favor?
Aye.
Aye.
We are now adjourned. Thank you.
Thank you.
Yeah.